Welcome to the Mass Journal. I'm the Masses, and this is my trading journal based on my trading perspectives and my trading experiences. The motto is improvement, maintenance, and victory. Today's lesson we want to talk about. Let me think who we need to talk about today. Is it the novice trader? Is it the trading trader? What is it? You need to understand the context of each video that you watch. Are you teaching the learner, or are you teaching the architect of structure? Because here's the thing, I spoke about this in my previous video, that in trading you have to have two personalities in terms of structuring out your work: the trader and the architect of the structure. Now here's the thing, another thing about structure. Structure is just foundation. The trader does everything else. There's profitability. The sense of profitability is account management. And I set it out to have two goals. Account management, it's not even I set it out. Account management has two goals. I've come to agree to those two goals. When or once you achieve profitability, the goal is either one, you're growing funding to capital, meaning I have 25K, I'm growing it to 100K, or I have $10, I'm growing it to 100K. I have $100, I'm growing to 100K. Now, you're going to hear people say, that's impossible. Here's the thing. Trading is a scalable business. Eventually, you can get there. And I'm going to explain how. And these are things that I'm putting up in my journal. I'm on day 9 of my project trading, project 90, where I fund a small account, minimum deposit $10. And I grow that to 200K. The last time we did that, we made 78 pence. Now I want to make 200K. And again, I said, I hate my slow trading process. And as time went on, as more research was done, as more trials and errors were implemented, I found out it's not necessarily that I hate it. It's more of, I didn't pay attention and I didn't really understand it. I didn't fully understand it. When you trade, you're growing capital to funding. That's phase 1. And then number 2, I didn't mention days. I mentioned days for myself because it's the structure to help me win. Now, when it comes to a process, your process is not going to help you. It's not going to make you win. It's going to put you in a position where winning is likely. Now, even if winning is likely, you can still lose. So your process also saves you that given that I do lose after being placed in a position of winning, I'm still okay. Then number 2, utilizing capital consistently, utilizing capital positively consistently. That means if I grow my $100 to 100K, now I have 100K. Now, reminding, getting to that point where you can do that, it takes a long time. Now, the reason it takes a long time is not necessarily because trading is hard and frustrating. No, it's because you just need experience. Trading is a fairly new industry. So anything that you create is some sort of an innovation to the industry. Kind of like support and resistance and all that. These are elements of running trades. These are not elements that you can utilize in terms of saying, this is how the market works. The market doesn't work based on support and resistance. It happened to be at support. It happened to be at resistance. You get to understand those points as you trade, because account management is experience in real time. How do you execute in real time? So the sportsman, the surgeon, they have to go out there, equip themselves with the necessary skills and tools, mindset, perspectives to be ready, ripe for the job. A surgeon, as much as they've read so many books and they've interacted with so many experiments, when they do perform the surgery, they have to focus on what's happening in real time. So trading is also like that. Now, traders, we tend to get trapped in the perspective of process, that we create a process and structure for so many years because losing is what creates that structure. You don't create that structure only based on winning. Most of your successes in trading comes from your losses. Losing creates that structure. So once we're done creating a structure, we start perceiving it as if I'm not supposed to lose. No, it's not. You're not supposed to lose. This is just structure to show that you are complete to be able to take a loss and still move forward progressively. Now, when we talk about the surgeon and athlete, they understand the theoretical part of their field, they understand the practical part of their field, and then they understand that there's game day. On game day, there's formation, there's tactics, there's the perspective of the game, which is this might be a final, this might be a group stage game. There's all that. Same thing when it comes to surgery. It's either you performing surgery on a kneecap or replacing an ACL, MCL, or you're performing heart surgery or brain surgery. Now, the context becomes different. A surgeon understands most of these. Now, obviously, there's specific surgeons, the brain surgeon, the heart surgeon, and all that. So in trading, you can also do that. In sports, you can also do that. I'm either the striker, I'm either the goalkeeper. Now, there's different types of sports. Boxing. Now, boxing, you are alone, but you have a structure. You have sparring partners. You have a coach. You have a training system. You have a camp. All this prepares you. This is your foundation to show you that you can. You are capable. You are allowed to. So your process is what shows you that you are allowed to. It shows you what you're allowed to do, what you're capable of doing. It does not say you are going to win. Match day and how you perform is what tells you that you're going to win. Now, I'm on day 8, day 9 today. And journaling saved me. This is a process that you have to perform when you do trade. There's 2 types of journaling that I laid out in a previous video. I think it's direct journaling and indirect journaling. Direct journaling is when you are trading. For example, I set out a trade goal. From day 1 to day 90, I want to grow a specific account size to a specific capital. Now, the market is inefficient. So today I could make half of what I want to make in terms of my goal because of the market's inefficiencies. Now, again, you have to be skilled enough to do that. So same time, some days you could just knock out the fight in the first round. You could just score a hat trick in 9 minutes, Lewandowski. You know what I'm saying? Or you could just perform the first ever surgery to something. I don't know. Maybe there's a tumor on the heart that's connected to, your back, and you perform that. That's because on that day, context and the performer were on level par. The situation allowed it. Some days, it's not so fortunate. Some days you do perform surgery, and it's the easiest surgery ever. Like, I just need to remove maybe a tumor from someone's arm. Remove that tumor, the person dies because there were further complications that you didn't know. So in trading, it's also like that. Some losses, sometimes they just happen. In sports, sometimes you just lose. It happens, even though you're prepared. But your process allows you to overcome those positions of misfortune, those missteps, because it shows you the overall goal that you're not only working for this moment. Yes, you can benefit from this moment highly, but it's not this moment. It's an accumulation of moments. And over time, you build consistency. Now, this is phase 2. Phase 2 is growing capital consistently. You cannot do that if you don't have a process. Now, your process, again, is not to say you are going to win. It's to put a foundation, given that when you do win, you understand where you're going. When you do lose, you understand where you're going. Now, here are the things that actually make you win. I was talking about my slow, gradual trading process and how much I hate it. And I hate it because, to be honest, I was not reading my journals, and I didn't necessarily understand what I was doing. And not even that, it's because as time went on, as I implemented more research on my work and evaluated more of my performances, you learn. And I started to learn more and understand it more. So I understood it, but from a surface level perspective. Now I understand it from, okay, this is what I was actually creating. What are our profit accumulators on a day-to-day basis? Now, what makes you profit as a trader? Now, it doesn't matter whether you're a novice or an advanced trader. Trading is risky. You have to be able to be capable in real time. Here's the thing about trading. If I set out a 90-day goal, the most important thing is today and 90 days going forward. Whatever happened in the past does not matter. If I don't have structure, I have to be able to create it as the 90 days go by. Now, again, your process is not the reason you win. You win because you are the winner. How are you the winner? From day 1 to day 5, context is expressed in a specific manner. Context that has never been expressed before. The structure is still the same. The market is a continuous system. Yesterday's context is connected to the day before. That's how we find the probability, because it's continuous. But that continuous system doesn't ensure that this is how it's gonna conclude. Trading is reactionary. You have to be able to react to the moment, given that it doesn't conclude the way you want. So it's usually like this. The easiest way to understand this is if you find a trade at 8 a.m. it's a W. It's a bearish reversal. Or we could call it a bullish. I don't know what to call it, but a W it's a reversal of a bearish trend. You take that trade at 8 a.m. 10, it hits your stop loss. Now, before it hits your stop loss, you have to acknowledge in your mind it's 8 a.m. I can't be putting all my eggs in one basket. It's 8 o'clock. There's so much price action still left to conclude, whatever movement that's here. Understanding the market, whatever was supposed to happen will happen. And what is happening was supposed to happen. That means at the end of the day, that 8 a.m. Signal that failed at 10 a.m., it was supposed to be like that. Your problem is that you risked so much. Now, many traders are going to ask, how were you going to know that? It's not necessarily a known. It's like a phenomenon that you need to understand. It's a psychology, It's not that at 10 a.m. the trade was going to hit your stop loss. The trade could have not hit your stop loss, It's 50-50. But given that it did, understand that what happened was supposed to happen, and what is happening is happening. So these this understanding of context, dealing with context, takes skill. Again, you need to learn how to interact with the charts using your account, because the goal of a trader is to grow funding to capital and then utilize capital consistently. And you cannot do that without actually going through the journey of the trader, because these reactions have to be trained in you. So in trading, we're training the understanding of basic charts. That charts are either direct or reflective. And then we're training you how to react to this direct and reflective price context towards your account at the specific moment. So in time, right now in time, how do you utilize your account? So understanding your account size and the broker you use is very important, because it tells you what's possible with your account. Again, those are structures that are not necessarily taught or told. These things the market tells you. When you fund, the account tells you what's possible for it and what's the best way for you to risk in real time. So you cannot necessarily write this down. The only way you can write it down is as a statement that the account does tell you. You can't say, you need to act like this. You need to target $200 first. You need to lose consistently. That's impractical. It's not real. How do I know? When we did our first project, I had a small account and I was trying to get a consistent loss size. Like, you lose small consistently. Can't do that. Even when you win, you can't do that. You can't lose small consistently. It's not progressive when it comes to your account, because some of the trades are more costly than some of the trades. Some of the trades react differently than some of the trades. Context changes. As much as this W worked out in my previous project, this 90 days, every W I interact with could conclude as a loss. And what do I do with that? And then there's this perspective that if you utilize your confidence over time, you're going to make money. There's no such thing. If you react correctly to the market over time, you're going to make profit. Your confidence can lose 100 trades in a row. Not because it doesn't work, but because every signal at every given point, every market point is 50-50. The easiest way to understand this is look at the chart for what it is. If you're looking at the daily, read the candle for what they are. Look at the first candle ever on the daily chart. It was 50-50. The next candle is either going to be bullish or bearish. The only thing we didn't know was the size of the candle. Then after some time, as time prevails, the market creates structure. This structure shows you what trade is running, what is probable in real time. So that's basically it when it comes to the charts. So I wanted to talk about the profit accumulators, but I'm going to talk about it in the next video. In this video, I think this is enough. Every trader aims for funding to capital, then capital consistently managed over time. We don't necessarily trade. What we do is account manage. Account manage based on what the context that's given by the market. You can have a conference that's successful or that has been successful for 10 years, and then it becomes unsuccessful for the next 10 years because it was never the confluence that made you successful. It was you and reacting to what the context is giving you. So if this W hits my stop loss at 10 a.m., there's so much price action remaining to conclude the day, depending on the time frame I'm using. If I'm using the hourly, in this case, I'm making hourly example. I'll take a sell to the downside and what? Make profit. And not say, I utilize my confidence and lost small. No, making large profits is also another form of risk management. If I get into the market with $100 and you get into the market with $100 and you see that W, you risk $80 there and I risk $20, I lose $20 by 10 p.m. and I risk $80 to the downside and you lost $80 and you risk $20 to the downside. Now, we also want to be in different mental scenarios. You will be scared to hold your trade for a long period of time because you just lost $80. Now, can your process save that? Can your confluence save that perspective which you are in? No, you just have to acknowledge as a trader, I risked so much because I was looking for this. Your reasoning in that scenario is what's going to save you. That's why you journal. Today, I had $100. I risked $80 at 8 a.m. because I wanted to return this much. I lost the $80. I took a $20 trade. I closed it at $40. It's a good trade, but now you still have to rebuild. You are working from a place of inefficiency, lack of confidence. In reality, in retrospect, it's not a place of a lack. Your account is built to fluctuate. Even if your account goes to $1, it's not bad trading. As long as your account can still take a trade and you can still hit your goal over that intended time period. And again, the time period is not a real thing because you can literally just trade as slow as you want until you hit your target because trading is scalable. But you don't understand these things if you don't let the market teach you. So what happens? I take my trade, $80. I let the trade run. It happens that the trade reflects on a daily chart for the next 4 days. I make 500 USD from a singular trade in 4 days. You'll hear people say now, the confluence is trading the daily. The confluence is the hourly and the daily. No. The confluence or the context of this situation is me. I understood how the daily operates. I understood how the H1 operates, just like you do. But I interacted with the trade that was available today. And I managed it. Why? Because it's based on my account. It's not necessarily based on my strategy or structure. Because after I close a trade, I have to find another good trade. You find another W, the market consolidates. You have to turn that into a good trade. How do you do that? Stay out of the market. Bracket it out. Look at a different time frame. And then risk upon that. And still the time frame can still lose. So you manage that, you gauge your risk, you lose small. And these are like, what is this? The main things of how to actually be profitable. Profitability in terms of its actual structure is losing small, winning big, not blowing, and performing consistently. Those are the 4 things that you need to focus on. Every time you trade on a day-to-day basis until you hit your goal, ensure you lose small, ensure you don't blow. Because not blowing is not, it's not saying not blowing is profitability. No, it's just the standard. I don't want to be using my money to come into the market and blow. It's just the standard. If you have a lot of money, you could, yeah, you know what, I don't mind blowing. But again, you could be trapped in a cycle of consistent funding without profit, which is bad. You want to not blow to show that you are capable of doing what you set out to do. And now this thing starts clicking in my head that, here's the thing. When they say 1:1 in terms of profit making, it's the most ridiculous form of trading. It goes against structural norms. Most traders, here's the thing, most successful traders understand account management. They don't care about trading. If I find a W, I don't need this entire W. What I need to do is that the first few hours, I'm in heavy profit, my account is stabilized. That's it. That means for 10 days, this trader can get into the market and just wait for 1 hourly candle by over leveraging so much that after an hour I'm out. Because I'm not attached to the trade. I'm attached to the growth of my account. And that's trading for you. The only thing you should be attached to is whether your account grows or not. And these are the techniques you need to develop around your trading. You don't need to develop technical, too many technicals, because technicals are the same. It's either the market is direct or reflective. Nothing else. It's directly a W, or this W is reflective to the H4 or daily. And you just need to benefit from specific moments. You can either benefit from the entire move, use a smaller lot size, not because the market is going to blow you out. No, it's because it's scary. You use 10K on one trade that's most likely to go for 17 hours. You don't have that edge. Many traders will tell you it's because you can't hold it. Nah, you can. You can hold the trade. The reason a lot of us don't hold this because it's too scary. I don't want to risk 10,000 USD on a singular trade because it could go against us. So it's not logical. It's not logical. But is it practical? Yes, because you just need one win to stabilize your account. Now then, the argument comes to the situation of, but what are you going to do consistently? Consistently, you want to lose small. Consistently, you want to win big. Consistently, you want to try to not blow. Consistently, you want to perform consistently. And performing consistently is understanding context and taking advantage of that context. Not to say this W concluded the way I said it. Who gives a fuck? Did I make money from that W is what matters. Whether I traded for a second and I made more than you, I'm happy. I'm going to my room, I'm going to pop bottles, and that's it. So the mindset should be that. It's not emotional. It's logical. You don't necessarily need to understand the entirety of the market to be profitable. In the next video, I'm going to talk about profit contributors or profit accumulators, which is direct context, which is what you see on the chart, aligned context, which is a combination of 2 time frames and how they reflect your trade, and that's why you get in and get out. Available context, what you find. Sometimes what you find can make you profit, and depending on how you risk and how long you risk, you make profit. The main thing is about growing your account progressively every day. Structural profit mergers or profit structural mergers is what I'm saying. That you have 2,000, there's a W. I can raise that entire 2,000 in an hour, grow my account to 10,000, and now I can grow my account gradually on a day-to-day basis. Yes, does that method get addictive? Do you feel like I want to do it always? Yes, but that's why you have a process, you have structure, a foundation to work on, to know that this is just for accumulating profit. It's not necessarily how I need to trade every day because it's stressful. Number 5, time. You cannot lose small consistently because signals are different every day, but you can win gradually every day. Now, because signals are different, some days there's a large signal, some days it's a short signal. When I talk about large and short, I mean the actual movement, volume, and volatility is short on that day. There's nothing we can do about it. Our worst nightmare as traders is the market moving sideways after we take a trade because we don't make money. I'd rather lose a trade than have the market move sideways. Okay, maybe I'd rather not lose a trade because some losses are different. Sometimes the market can just spike you and move in your direction. So time, what is accumulating with time? Time is understanding. Yes, I put out 90 days. And this 90 days to make me understand that you don't need to grow your account day 1. You don't need to grow your account day 10. What you can do from day 1 until day 90 is collect small wins, which is you find a W, take it with a smaller slot size. There's nothing more available besides the smaller slot size. And you winning the trade is profit regardless, which is what you want. If you do that over a period of 90 days, the losses that you will take will be manageable. They won't be small, but they'll be manageable. the wins that you take will be large because you can allow them to run. Now, because trading is scalable, after 90 days, your account will be big, inevitably. And this account that's big was built off you trading consistently for 90 days. Now, if you trade consistently for 90 days, you develop certain skills in your trading, which help you accelerate your account growth. So this is time. For me, time is the biggest profit accumulator, the biggest profit contributor in trading. It's the best. Now, again, this 90 days is for me. You don't need to put 90 days. You can put up 12 months, 3 years. Trading has no time limits. It's about choosing the best signals that produce outcome, regardless of the lot size. That's the perspective I utilize time from. Choosing the best signals that profit you, regardless of the lot size. Then leverage, number 6. Leverage. You find a good signal, you put out maximum leverage. You don't even need to be in that trade for too long. It moving in your direction for an hour is good. Now, people will say, what about a drawdown? Here's the thing. A signal has a price. If this is a W and the price of the signal is like $20 and I have $100, I'm going to risk that entire $100. I'm going to put out all trades $100 because I know if it hits the stop loss, it has to completely invalidate one structure. That means I'm completely wrong. Now, if it doesn't invalidate, I just need 1 hour of price movement in my direction, and my account is doubled, and I can trade normal. Now again, it might not even double. It might even, exponentially multiply, because volume and volatility, we don't control that. Our worst nightmare is the market moving sideways, and today the market doesn't move sideways. The problem with leverage is management of the trade. It's very hard to manage a trade that is leveraged. So that's the con. Then lastly is number 7, fluency, account energy. And this is something that people don't talk about, which is the level in which you are capable of growing your account besides your process and your structures and all that, is your broker and account size. Where you fund and what you fund will tell you what is possible. If I fund $100 in Exness and you fund $100 in IBF or IFX or something like that, IFX is more volatile than Exness. We find a W on NASDAQ, I take that trade with $100. Perfect trade goes into a direction. You take that trade at $100, you're in a profit of $2,000 within 3 hours. I'm in a profit of $150 within 3 hours. So your broker tells you what's possible again, and it tells you what type of energy you need to trade with. So fluency is understanding that. It's understanding that once also your account, it's also deeper. After understanding broker, how much you fund and where you fund, it's understanding progress. The more you progress, your account will teach you what is necessary. Your ability will teach you what is necessary. So when they tell you that profitability or profitable traders is about understanding yourself, it's not understanding yourself when you're not trading. It's not understanding yourself when you're just journaling. It's only understanding yourself when you're participating with an actual account as you hit a trade goal. That's why you have a process. Your process tells you what you're working on. I have account size, account goal, account period. Now you understand what the period is for. It's not to force you in, but it's to help have something accessible once we complete trading. So fluency allows you to grow your account in an efficient way, inefficiently. Today you make $10,000. Tomorrow, the day after that, 500. Because the account is telling you what is safe for this account, what you should risk on a day-to-day basis, what you should bait the market with in terms of finding out where momentum is. You find that out about yourself once you place the trade, once you get your first win. If you don't win, you won't understand it. Your first win will tell you that, okay, this is what the market in this account is telling me in terms of growing this account quickly. It's telling me to use this type of energy and effort behind it. Like a small account, I'm in day 8. This small account, because it's on Exness, is telling me you can't sleep, bro. You can't sleep. You have to be here 365. I'm okay with that because I understand trading is scalable. After day 40, 50, I'll be at a position where I can scale, where I can sleep. Now, okay, I have been sleeping. Fuck that. Fuck all that. Anyways, so those are 7 profit accumulators and the perspective behind the process, the perspective behind the goals that we want as traders. We'll grow funding to capital. Let me conclude this. When it comes to funding to capital, understand, okay, I don't have my book, that there's 3 ways. It's either you're growing your funding to capital, or you're growing your funding to capital utilizing time, or you're growing your capital, your funding. It's like this: 25,000 to 100,000. That's funding to capital. 25,000 to 100,000 in 90 days. That's funding, capital, and time. Then 25,000 in 90 days. That's capital and time. Last one allows for fluency because those 25,000 can grow the way it wants. But at the end of 90 days, you have to have something substantial and sustainable. Because if your account doesn't grow, what are you doing? You're not trading. The goal of trading, the reason I say funding to capital is to emphasize the point that you're growing from a specific account to a specific account. Funding 25,000 and then withdrawing when your account's at 35,000 is senseless. You just made 5 bends. We're not trading for that. We're trading for exponential growth. If I fund 25,000, I want to make 100,000. That's the trading for you. So yeah, the motto is improvement, maintenance, and victory. That's what's up.